Welcome back, everybody. So in a previous video, I talked about how there's a multitude of cognitive and emotional biases that can affect our rational decision-making when it comes to investing. Now, this video isn't about those, but I do want to mention one, and it's called the overconfidence effect. This is when a person's subjective confidence in their own ability is greater than their objective accuracy. So an example of this, there was a really interesting study done on a large group of university professors. They were essentially asked to assess their own proficiency, and 95% of them said that they were above average teachers. And this effect is actually pretty common. I'm sure if you asked a large group of asset managers in the financial industry to assess their own proficiency, I'm sure 95% of them would come back saying that they're above average and doing well for their clients. And it's interesting that this overconfidence effect actually extends to the clients themselves. Of all the people I've spoken to over the years about how happy they are with their financial advisor, it's amazing how often the answer comes back, maybe not thrilled, but certainly satisfied. Most people think that their advisor is one of the good ones, certainly above average. And this may be why so few people actually leave and seek out something better. If you can't objectively assess the situation, it's pretty tough to solve the problem. The advisor says you're doing well, the clients think they're doing fine, so another year goes by and nothing changes. But we know for a statistical fact that a pretty high percentage of active fund managers actually underperform their benchmarks. So how is it that most people think everything's fine? Now, it may be difficult to mathematically assess whether somebody's actually a good teacher or not. That's pretty subjective. And to be honest, for me, growing up, I felt like most of the teachers I had were pretty good. So maybe I'm suffering from overconfidence effect as well. But in the investing world, it's actually very easy to determine whether a fund manager is above average or not. So that's what this video is about. Let me get into some details. So let me ask a simple question. Or it could be a simple question, but to be honest, most people won't have the answer. And that's fine, that's what this video is about. But what annualized rate of return has your portfolio achieved? What's that number? Because if we know the start date, we can find out in a couple of minutes what a realistic benchmark achieved. Something like the Vanguard VBanks, for example, 60% stocks, 40% bonds, and an expense ratio of about 0.2%. So in no time at all, we can find out exactly what the VBanks achieved over that same time frame. Your advisor may say you're doing well, and because of overconfidence effect, you might think you're doing just fine. And this isn't meant to be a negative video, I should say that. Perhaps you are doing very well, and you might be killing it for all I know. But my only point is, I'd like to encourage you to actually find out, and it's a lot easier than people think. All you have to do is ask them for your time-weighted rate of return. This is a simple measure of the compound growth of your portfolio minus inflows and outflows of capital. So it's essentially what your portfolio has achieved due to direct investing activities, and it can be reduced down to a single number. But why is this important? Well, most investors are still in their working years, so they're going to be saving money and periodically adding to their portfolio, which I would definitely recommend people do. This is a good idea. But it also means that even if there's no growth at all coming from direct investing activities, you may still have a growing portfolio. But if we're not careful to separate this, it's pretty easy to think everything's just fine. Maybe you started with $50,000 a few years ago, and now you have $100,000. We're right on track, right? But how much of that is just you adding money? And if you're retired, it's usually the opposite. It's pretty easy to make a case that everything's fine. Your fund might actually be on the decline, but that's because you're regularly withdrawing money, right? Or maybe you pulled out money to buy a home or to send one of your kids to college. The waters can get muddied pretty quickly when the majority of the time we're only looking at our account value. You started with this much and now you have this much. But that's not good enough. We actually have to know how much of that is due to investing and how that compares to other available options out there. Now, the good news is it's very easy for your advisor to calculate a time-weighted rate of return and to give you that number. And then you can take that and compare it to something like the VBanks. And I'm not talking about 6-month or 1-year periods. Of course, everybody underperforms from time to time. But if you stretch that out a few years and you're still underperforming index funds, we may have a problem. So it's important to get that number. Now, unfortunately, there is some bad news. Because we already know how many fund managers out there don't actually beat index funds, in some cases, it might be like pulling teeth to get this simple time-weighted rate of return number given to you. You may be more likely to be presented with a 6-page detailed report with pie charts and line graphs and explanations of all of your allocations than you are a simple time-weighted rate of return. And of course, those reports are often misunderstood and sometimes even outright ignored. But anybody can look at two numbers and see which one's bigger. Now, I'm not suggesting that you make any decisions here. Of course, your investing goals are specific to you. And if your advisor is underperforming, maybe there's a reason for it. But the first step in solving a problem is accurately assessing the situation. That's all I'm encouraging you to do. Find out, because if we don't know exactly what that number is, everything else is just guessing. And as behavioral psychologists will tell us, we're usually pretty bad at that. Overconfidence bias. Without actual numbers, we usually think everything's just fine. Question of the day. Do you know what your time-weighted rate of return actually is? And how does that stack up to a benchmark like the VBinks? Please leave a comment down below. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comments section. See you next time.